Do you want to easily diversify your portfolio and leverage your existing knowledge of option trading? Options on futures may provide the vehicle you need to manage risk and diversify your portfolio. Whether you are looking to trade in an uncorrelated market to diversify risk, hedge existing positions to limit risk, or directly trade more volatile markets at a reduced cost compared to the futures contract alone, options on futures can be a way to do this. In markets like oil, gold, and silver, you may see swings of over 2% in one day. These markets offer plenty of setups for someone who likes to trade volatility and already has familiar setups from the equity options market. As an options on futures trader, when you buy an option, you can still be involved in the same large moves, but will only be risking what you paid for the option. Let's look at an example. If a 50-20 call in E-mini NASDAQ NQ that expires in 4 days is worth 24 points at a time when the 14-day average true range for NQ is around 50 points, meaning a move around 25 points up or down each day, this trader is risking approximately 1 day's average move, but can leave the trade on for 4 days, thus limiting risk with the potential to see the trade have a large move in your favor. The amount you risk by purchasing a call in this trade is always no more than 24 points, even though the option can have large swings in price up or down. In addition to limiting risk, options on futures may complement existing equity strategies and add diversification by providing trades in uncorrelated markets. Markets like corn, soybeans, or the euro currency will move differently than stocks or the S&P 500. So, a trader who may want to have multiple trades can spread their risk across multiple markets while using similar trade setups. For example, a trader who holds mainly equities could look at an uncorrelated market to add diversification to their portfolio. They could buy an at-the-money long-dated call in soybeans, ZS, if they think that the soybean market will increase over time. If soybeans are trading around 1,004, a trader could buy a 1,000 call with an expiry in 7 months for around 45 points, using the at-the-money contract. Options on futures traders can also manage portfolio risk by hedging specific positions. For example, an investor might hedge his equity exposure by using an E-mini S&P 500 options contract. If an investor wants to reduce or hedge foreign currency exposure, they can use options on currency futures. Because of the varied asset classes that futures contracts represent, investors can selectively hedge most, if not all, of the asset classes in their portfolios. You can even hedge to take advantage of short-term moves. If you think the market might move lower than the rebound, you can hedge a long-term futures position with short-term weekly expiry options on futures. For example, a trader who is long in the E-mini S&P 500 futures contract and thinks that the upcoming Wednesday Federal Open Market Committee announcement has the potential to push the market sharply lower, he could buy a put option on the ES futures with a Wednesday expiry to protect against the potential downturn and protect his profits. Whether you are looking to reduce your cost when entering trades, hedge to manage portfolio risk, or complement trades in equity markets, there are advantages you can leverage by including options in futures.